Hey everyone, it's Daniel here from InfoRest. Hope you're all doing well. Want to talk about the CPI inflation report. We got that yesterday. The numbers came in lower than expected. So if we look at here, the core CPI month over month, it comes in at 0.3% versus the expected of 0.5%. And the year over year core number comes in at 6.3% versus the 6.5%. And the headline numbers year over year 7.7% versus the 8%. So we're seeing that nice decline. And the CPI month over month, again, headline is 0.4% versus the expected 0.6%. So the whole report came in lower than expected. This fueled a lot of optimism in the markets yesterday. And to add on, the core CPI number was actually the unrounded number around 0.2 something, right? So, which, if we round it is 0.3. So that's quite low. And that definitely fueled in the equities. It fueled in the bonds. It fueled gold. It fueled currencies, all to rally. Bitcoin to rally, crypto to rally, even though crypto markets has been under a lot of pressure with the FTT scenario there and the FTX going under and Binance not buying, etc., etc. But that's a whole other topic that we can talk about later. But we did see a rally, a very big rally yesterday in technology stocks, in risk assets, bonds as well, gold as well, currencies, and the dollar falling. Just basically telling you, the market's telling you that, okay, some sort of pivot is coming, repricing of interest rates, and so on. Now, here's the thing. This whole year, every time we get some sort of soft data or news or comment, we tend to see the bulls come out and talk about this pivot. And they keep doing that. And yesterday is a very good example of that. And, eventually they're going to be right. Now, this term pivot can be used in many ways, can be defined in many ways for many people. But how I define a pivot is that you're going from rate hikes to now rate cuts. And I don't think we're going to get there. And I don't think we're going to get there unless there is some sort of recession or something that breaks. Now, here's the thing. Even if inflation is coming down, and this is just the first number, we still need to see December's number, and we got a lot more numbers and data to look at. But this inflation report is showing signs of weakness because we're starting to see the effects of the tightening that the central banks have been doing. So the fact that this tightening is causing certain components of the report to show declines doesn't mean that that's a good thing, right? I mean, it's a good thing in terms of inflation's coming down, but it doesn't mean that's a good thing for risk assets. And I think this is where the market is getting it wrong, in my opinion, right? Who knows? I could be wrong as well. But in my humble opinion, I believe that this is where the market is getting it wrong. I believe the market is getting it wrong because they believe that this pivot and that this lower inflation report means that we're going to get this pause or this rate cut, and then everything's going to be fine and we're going to rally all of a sudden when the Fed starts cutting rates. But in fact, my opinion and what some of the data and historical data suggests that as this continues, the tightening, and as the Fed has told us, sure, they have slowed down the pace of the rate hikes. They may not be doing 75 in December, probably going to do 50 basis point rate hikes, but they do expect that rates will continue to move further and higher and stay elevated for a long period of time, but just at a slower pace. That doesn't mean that we have paused or we're doing rate cuts. And this will continue until we see signs of something breaking, until we see the unemployment rate increase, until we see growth completely collapsing, until we see all of these negative indicators that suggest that, okay, yes, A lot of companies are laying off workers. Recession is getting worse and worse, and it's getting ugly. And at that point, sure, you may think that, okay, the Fed pivot is coming because things are breaking, but that should not be positive for equities. And at that moment, that's where we can see the stock market, the equity market sell off while maybe the bond markets start to pick up. We've been seeing both stocks and bonds sell off together because of this tightening. Now you would think, okay, this pivot's coming, that means both stocks and bonds to go up. But actually, I don't think so. Actually, I think next year when this data starts to show that, there is really big problems within the economy, and hopefully the equity markets will realize that this pivot is not as bullish as people may think it is, as traders may think it is. And because of that, and as yields come down, and as they start to cut rates and decide to cut rates, and bonds start to move up, that's where I think the massive sell-off will happen with the equity markets. So actually, a pivot, in other words, a pivot is actually a bad thing for the equity market, for the stock market. You don't want a Fed pivot to come, because then it may signal that, hey, the crash is actually here when the Fed pivot happens. And the Fed pivot may happen at a very slow pace, just like, you might have seen or heard in 2008 when they started cutting rates there. They did it in kind of this slow manner where in the first meeting they cut rates, and then the next meeting again they cut rates, and so on. So they may not go bazooka rate cut. They may do it in increments, and just to see how the economy is coping, but they do want to see that inflation number come down. And how do you bring that inflation number come down? Again, it's going to be from that recession. And sure, when things break, they have the tools. The Fed did come out and say this. They have the tools to accommodate the economy and ease the constraints, and by cutting rates and stimulating printing money. Now, to get to that point, to get to that real pivot, the break needs to come. The collapse needs to come. So it looks like more and more that although this data is showing, the CPI data is showing weakness, and although there may be signs of cracks, if you look at the yield curves still around the world, they still suggest very, very bad, like something very bad to come. We don't know what, but the inversion in the yield curve does suggest that. The data is starting to show that. The layoffs that you're seeing with big tech and many companies are showing that. And we're starting to see the true signs of the tightening, which again shouldn't be taken as, okay, the Fed is going to pivot, so everything's going to be fine, so let's buy equities, buy the dip. I think this is still not the dip. Although, don't get me wrong, short term, medium term, we may have a rally in November or December on this kind of theme, on this optimism. We could have a technical rally, we could have, it could be anything, right? But I don't think it's over here. And it could be, I would say that a pause or a break in the equity markets, especially as we're heading into the end of the year. You have institutions looking to rebalance their portfolios, looking to sell. People who have been short, institutions have been short, who want to, take their bonus and not lose their bonus for the year end and have been making money on their short positions. Yeah, they got to either take profits now or hedge their positions by buying long positions, or whether it's equities, or whether it's calls or derivatives or what have you. They will probably be taking the long side, not on the idea that they believe that markets will rally, but because they need to take their profits or lock in those gains. So sure, you can have that rebalancing happening at the end of the year, and then 2023, we wait and see what happens. Now, when I look at this CPI report, we still see certain components strong and certain components have come down. Like for example, the vehicles, the used cars and vehicles, we've seen here negative number for October. So in this report, we see that the used cars market has come down. We have heard from news around that the auto repos are at all-time highs. There's, the auto market has been crashing. There's about approximately, from what I've heard, 15,000 cars being repossessed every day in all of America and nationwide. So we also see apparel, so clothing, falling as well. However, you'd still see shelter quite elevated. Transportation services elevated. Now, medical care services have dropped. We see food and food away from home still elevated, right? Certain components as well in the energy commodities have also are also elevated as well, and energy services, they seem to be down in this report, and the utility pipe gas services also down. So although the report overall may have been lower, and again fueling this optimism in the market, but don't forget, look at the report, the CPI report from the BLS website. You do see food and most importantly shelter, the things that we pay and things that are essential to us. We need a place to live. We need shelter, roof over our head. We do need to eat. They still continue to be elevated, and it still may take time for those numbers to come down. And again, like I've been saying this for a very long time, you need a recession in order to bring this inflation down, to bring it into, forget about the 2% target, bring it into negative territory, to crash inflation. Yeah, there needs to be some sort of ugly recession that comes in. And don't think that this pivot would mean that it's all good for equities and risk assets. You can have the pivot and still have a massive sell-off in the equity markets. So that's my take on the CPI report. That's my take on the equity move, the equity market move, and the bond market move. Much more to come. It will be interesting to see what the next CPI report comes in as. It'll be interesting to see how oil plays out, how these commodity prices are trading, and continue to monitor the Fed communication, the development that's happening from the monetary policy point of view, and we'll see what happens as we approach to the end of the year, if we get that Christmas rally and the portfolio readjustment and so on. So let me know what you guys think. Leave a comment below. Hit the like button, hit the subscribe button as well, and hit the bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.